Welcome, fellow colleagues, to this month's Month Ahead. It's going to be quite a busy month, certainly at the start of the month. As you receive this, it'll be the 1st of July. We will have started receiving the Purchasing Manager Index data from around the world for the manufacturing. That's going to tell us whether these price increases that are making their way through the global supply chains due to the COVID-19 disruptions are really starting to affect factory prices and quid pro quo, by default, inflation. Now, we still don't know yet whether this is transitory inflation or whether it's sticky wage price inflation, which has suddenly made a reappearance after 20 years vacation. I still do have my doubts on that front, but it does mean important things for the rest of the world, because if the perception is that this inflation is sticky inflation, interest rates are almost certainly going to come under upward pressure around the world, most especially in the United States, which appears to be recovering much faster than the rest of the developed, or as we want to call it, the Western world. Obviously, a lot of that is down to the fiscal stimulus there and the huge vaccination program. But when we look at other parts of the world right now, the story is just not quite so rosy, is it? We've got 4 state capitals in Australia under lockdown because of COVID-19. We have an explosion of cases here in Indonesia. Singapore is still grappling with it. Malaysia, Thailand, Japan, Philippines, right across Asia are struggling with new waves of this pandemic. As are parts of the Middle East, and in the UK, cases are rising once again, and it appears to be making its way to the European continent. So we're still not quite sure whether tourism will return yet as we know it this year in Europe, and that will have quite large ramifications for the travel industry and all associated companies in that space, or with exposure to that space. We have on Friday, after the PMIs, the US non-farm payrolls, and that will probably be the biggest data point of the month, to be honest. So the non-farm payrolls started off with a hiss and a roar this year. Everybody, including myself, was expecting with the vaccinations ongoing in the US that the number would come in at above 1 million jobs added per month and the world would be saved. But it's been a bit of a damp squid in the last few months, and it's actually been reasonably disappointing. People are much more reluctant to come back to the workforce, it would appear, despite job shortages, than we first thought. And I don't think that's just because they're getting fantastic unemployment benefits. That is complete nonsense. There are a number of other factors at work over in the States. Nevertheless, after the FOMC changed its dot plots in June, bringing forward their expectations of interest rates into 2023, the markets are still nervous about any other signals coming from Tier 1 data, particularly in the US, that would signal higher inflation and then quid pro quo tapering and normalization of interest rates at a faster pace in the future. Now, that's quite important because we've been living on 0% central bank money since the global financial crisis, and we can see the results of that with asset price inflation everywhere, none more so than since March 2020 last year, where that ocean of free money has caused huge rises in asset prices and all sorts of funny corners of the financial markets, not just houses and equities, etc., etc. Of course, that all becomes a little bit more vulnerable if inflation's expectations change to the upside and quid pro quo, thus also higher interest rates. So if we have a soft number on Friday, we're probably going to see equity markets move higher and interest rates in the US move lower and the dollar move lower, because those fears will be mollified. If we see a much higher than expected number, somewhere around 1 million jobs, we're probably going to see the opposite effect. We're going to see a little teeny-weeny mini taper tantrum like we saw after the FOMC, where equities are probably going to fall, the dollar will rise, and US yields will rise. So that will give us some volatility to the start of the month, but then we move very much into the Northern Hemisphere summer, and then what we call the summer doldrums. But that doesn't mean that there's not anything else going on in the rest of the world. We do have interest rate decisions from China and from Japan and also from Australia around the middle of the month. I'm not expecting any change in those, particularly because of these COVID-19 fears that are subduing Asian sentiment at the moment, particularly. Their stocks have very much underperformed in the last couple of weeks. We have an FOMC meeting at the end of the month. Now, I'm not expecting that to be a live meeting. I think that will be the September one after the Jackson Hole Symposium in August, which will be much more lively. And also because most of the Northern Hemisphere will be on the beach by then, I'm not expecting the FOMC to give us any more surprises in the July meeting. However, it will be interesting to watch the FOMC minutes of the June meeting, which get released mid-month, to see just what the thinking was amongst the FOMC members regarding how they looked at inflation. So the excitement is sort of loaded towards the start of the month and the end of the month, and for the rest of the month in between, I suspect that summer holidays are going to be more on people's minds. We need to watch the trajectory of this Delta variant of COVID-19 and to see whether it is going to cause more border closures or it's going to delay reopenings more critically. And I think actually if we're in this place a month from now, we're going to have to revise downwards the trajectory of the global economy. So sorry to be the bearer of potentially bad news at the end of it, but it's always best to be informed about these things. I wish you a great month ahead and take care.